Hey guys, welcome to Wealth Wisdom Financial YouTube channel podcast. As you know, we love thinking about money, thinking about the banking system, thinking about how we can be creative in our finances. And so today I get to interview a good friend who actually is an educator as well. He runs his own podcast and on um, educating real estate investors. And he also runs Pine Financial Group, right? So he is an amazing uh, author of the content, real estate educators podcast. So if you go there, you'll see a lot there. Successful hard money lender and mortgage fund manager. After, this is one of the reasons I really like him. He was 4 years in the U.S. Army, started his first real estate investment company, which is still active today. So if you guys know anything about me, I'm former military as well. And that background really helped me to do all kinds of cool things. So we're going to just ramble and talk about money, the world, how we're going to solve the world's crazy problems financially through real estate. So Kevin, how's it going? Are you ready to change the world? I don't know what.
Brandon, that was an awesome introduction, man. I can't wait to save the world with you on this podcast.
Oh my gosh, we need to do something. It is, we are, things are crazy.
There's a lot going on, that's for sure.
Yeah, I don't even know. I haven't looked at YouTube or the news today to know what happened today. That's going to give me whiplash. But
a little more consistency today. So
okay.
Sort of what you expected.
Okay, awesome. So Kevin, tell me, you are not your traditional as your Pine Financial Group is not just a financial services, put your money in Wall Street, which you probably
Right.
get that question all the time.
Right.
Oh, you're a financial group. Do you want to sell some ETFs? That probably is a regular call that you get in your firm.
Oh, for sure. And you know what we like to say is, look, Wall Street's great. I think you should have exposure to stocks and equities and bonds, and you should have a nice mix in that. And you should maybe consider diversifying into Main Street. So we say let's diversify out of Wall Street into Main Street, and there's lots of different ways to do that. We just have one option.
Yeah, that I love that. I was just talking to a client today, and they're like all in certain stocks, and I was like, hey, how does she was asking about what I do with life insurance and annuities. I said it's non-correlated assets. Like you want to have that kind of foundation. Don't put all your eggs in real estate, all of it, because then what could happen is a 2008 type deal.
Yep.
And if it's all on the same truck and it goes off a cliff, that's a problem.
Yeah, and 2008 is a little bit of an anomaly, like Brandon. But if you were in any investment in 2008, unless you were shorting them, you probably took a loss. So there is some correlation when you have what do you call it, like a black swan event like that.
Yeah. So how do you protect yourself from those type of things? Because I do think, and let's be honest, we're having more and more black swan events. So how do we protect ourselves?
Well, diversification is number one, in my opinion. I think you agree with me on that. Mm-hmm. I went through 2008. I was an investor. I was a private lender. And oh man, we could share some war stories about that time. I don't think we have enough time on your show to go through what I experienced. But I will say this, I took some significant losses in my real estate holdings. I had a portfolio of 55 rental units at that time. And that is a lot. And we were highly leveraged, adjustable rates, all of those things that are no-nos, right? So I learned a lot through that process. What I didn't take any losses on, however, is the private lending side. And the reason for that is, first of all, private loans are the very first in the capital stack. So if there's any money coming out of a real estate deal, the lenders get paid first.
Yep.
And most of your listeners probably own a house or some rentals, and they know that you have to pay off your loan if you're going to sell the house, right? So it
Yep.
is the first to get paid back, so it's the safest position. The other piece here is the loan value doesn't necessarily go up or down with the market. In fact, if everything performs as you would expect, it doesn't move in value at all.
Yeah.
Now, you collect your interest every single month, right? But the value of that note, what needs to be paid off, is consistent. So as the market was crashing in 2008, 9, and 10, our note value stayed consistent because our loan to value ratio was low enough to absorb those losses on the real estate value without impacting the debt value. Now, I know I talked a little high level there, so we could break that down, Brandon, for your audience if you would like. But what I'm trying to explain is the debt value doesn't move with the market unless it's a significant move or there are defaults.
That sounds more of as you do this kind of thing, you're creating more stable cash flow.
Exactly. That's the beauty of real estate debt. It's very stable
Yeah.
and it's secured, right? And now it's not a government bond or a treasury. That's debt also.
Mm-hmm.
So you would expect that to be very stable as well. Except for that's the government backing you. In our case, it's real estate that's backing you. And the interesting thing about treasuries, I just said it was stable, which is true if you hold it to maturity.
Yeah.
Where it's not stable is when you have to liquidate it, which is exactly what happened to the banks, right?
Yep.
Silicon Valley went down because of their air quote stable investments in treasuries.
Yeah. Well, and as people who work with me know, I do notes. I love notes because I can use my life insurance policy, a policy loan, and I can loan it out. And as you also said, one of the safest positions, because guess what? If the guy defaults or something happens, I'm first lien position.
Yeah.
So I'm in a better place, and I get my check every month, regardless. And he's done some extensions, kept doing extensions. I'm like, come on, let's finish this so I can do another note. But whatever, I'm still getting the check every consistent income every month.
And how hard do you work for that income?
I don't. I just gave them money. I did, I think, 2 transfers. They were, and why it was slow is because the bank was like, wait a second, something's happening. And so that whole thing was an extra day or something for him to get his money because they wanted to make sure, hey, what's going on? But really, it was pretty quick. And what's cool about this is I was able to do that, have it at the ready, put it in a high yield savings account while he's waiting to do a draw. And then when it happened, it was ready, but it was making money while I was waiting to deploy it.
That's a beautiful thing. And real estate's a fantastic investment in all aspects, in my personal opinion.
Yeah.
Rental properties will really make you rich. That has been proven, but it's not passive, right?
Yeah.
Even if you hire a management company, you have to manage the manager. Real estate debt is the only true passive investment in real estate.
So what would you tell somebody like, okay, so everybody loves real estate. They want to get rich super fast. And they're like, well, if I just have 100 houses, then I'll be good. And then you have if I just turn that in, all those 100 houses into a hotel, then I'll be good. Sounds similar. And then there's other ones that are like, yeah, well, I do it for the tax incentives. And then how is notes using this kind of way? How's this different? Is there benefits, tax benefits? And I know you're not a tax professional. We want to qualify that. And I know some of the answer, but why would somebody do notes as opposed to buying 100 real estate properties?
You're describing monopoly: 4 green houses, 1 red hotel, right? No, that is a formula for success, and it's been proven out many, many times. And there's some tax advantages with real estate, and I'm very comfortable talking about that. I am not a CPA or a tax advisor, but I do understand the tax benefits of owning real estate. Now, real estate debt is not owning real estate.
Yep.
I want to be very clear about that. So when I said it didn't move with the market in 2008 and I didn't take any losses on my real estate debt, that's because I didn't own the property, right? I was the lien holder on the property. So I was in the most secure position well before the owner. I get paid first, right?
Yep.
But because I don't own it, I also don't get the tax benefits. So people do not invest in real estate debt for tax benefits. They invest in real estate debt for the security, the stability, the consistency. And if you're looking at short-term value add investments like what we do, you're also looking at pretty high returns. So there's a lot of benefits to it, but Brandon, tax benefits is not one of them.
Yeah. And I wanted to make sure we talked about that because a lot of times, and you probably see this all the time, people come in and they're like, yeah, but I want the tax benefit, but I want this. And you're like, well, you have to pick and choose what you want, right? And then another thing I like is you could theoretically own an asset and be the renter and the owner of that, which I have done. And so I've used my policy to buy my office condo, and then I'm now I'm the mortgage in that case. And then my business is paying me rent, but then I can do some depreciation, all that fun stuff. And I know personally, I'm not going to rip up the walls, and I'm going to make sure I pay myself and do all the fun things that needs to happen. Right. And so I was both the renter and owner in this case. Safe investment, still risk, floods or things like that. But then I love the notes because I don't want to be a landlord, except to myself.
Yeah. One of my mentors just screams this out loud, Brandon. If you own a business, you should own the real estate.
Yeah.
So just like what you're doing, I did the exact same thing. We recently bought about 24,000 square foot building in Colorado, and we're moving our office into it. And there's a lot of benefits, including the tax benefits when you own the building that you're occupying. But like you, we sign a whole lease. It's two separate entities. We are the tenant. We're leasing from another entity. That really is the best way to do it.
Now, here's something again, we both do finances. And you probably look at other side, not just the lender who wants to give you money to give to somebody else, but you're looking at the person who wants money.
Yeah.
What do you look for to make sure you're not going to get, I don't know how to say this, bamboozled, screwed? Make sure your clients who are investing in you as did you vet them? How do you vet the people that come in asking, hey, can I get some money to do a deal?
Yeah, let me talk about that. But before I do, I want to describe the business structure a little bit to help bring some clarity around the answer I'm going to give. So we are short-term bridge lenders, and we raise private capital from our investors, and we loan that out to real estate developers. So think about your fix and flips. Maybe it's a office condo that needs a little bit of love before you can increase the rents and refinance it, or a apartment complex that's half vacant. Right? Those are the types of projects that we want to lend on. Very short-term, high interest rate loans. So our investors invest typically into a fund, so like a mortgage fund, very similar to a mutual fund where you have a manager who selects different investments, makes trades, moves money around, trying to maximize return by limiting a downside, right? So it's the exact same thing. We do that in the mortgage world. So the investments we choose to invest in for our passive investors are these short-term, high interest rate notes. So
and when you say high interest in today's world, I don't want to say if you're coming back later and you're like, hey, he said this, but today is 2025 January. What is high interest today?
Yeah, we're 13%.
Okay, cool.
Interest rate, note rates. So when we've been doing this for, I've owned the company. I started the company in 2008, and I was doing it for 2 years prior to that. So we're over 18 years of experience now, and we've surpassed $1 billion in deals. Yeah, our default rate is about 1.7. It's creeping just over that. So like 1.72, which is very low, especially for this industry.
Mhm.
And the reason we've been able to consistently maintain default rates of under 2% in over 18 years is because of the underwriting guidelines. We have very specific rules that we follow when looking at deals to invest in. And these include how profitable is our client going to be? How easily are they going to get through the project? What's their experience? What's their team?
Mm.
And then let's look at the personal financials that we get personal guarantees. So if you're telling me you're going to go out and do a fix and flip and you're signing on my note, well, if that doesn't go to plan, we need a backstop. We need your net worth to backstop that
Mhm.
loan so that you're promising to pay us back regardless of how well or how not well you do. So let's see, what does that net worth look like? What's the liquidity? Liquidity is the number one way to stay safe
Yeah.
in real estate, but in any business. Look, what my attorney always tells me, that you don't have a problem if you have enough money to solve the problem.
Yeah.
Right. So
Right.
if you need to make mortgage payments, if you go over your budget, you have to hold it for longer than you expected, any of these things is all okay if you have the money in the bank to handle it. So
Yeah.
that's the number one way to stay safe. So we look at that, we look at credit reports, we look at income. This is a full loan package where some people will say we take more risk than banks, for example. And I can see why you would say that because we're high leverage. Now, I'll loan 100% of the deal if the deal makes sense, as long as I'm comfortable owning that. So banks don't do that, right? Banks need money into every single deal. So we're a higher leverage lender. We're very much faster than a bank, but we charge a little bit more, and we still do qualify.
Yeah. And I wanted to say that because, again, as I work on my side, well, guess what? A insurance company is going to do their underwriting, qualify you to make sure you're not going to die tomorrow.
Right.
And if you're doing annuity, same thing, financials, and it's the same thing. There's not a quick, easy way, right? We need to do our due diligence. Otherwise, we are not in business,
That's right.
right? And so we have to make sure of that. And I bet you've probably seen a few in 18 years of somebody says, I have it in cash value in my policy. You've probably seen that a few times.
Of course.
And how do you look at that when you say, oh, well, he has this money at the bank, but he has access to 100,000 in cash value? Does
Yeah.
that favorable, helpful for you?
Oh, absolutely. So any liquidity that you have access to does help you qualify. No question about it. Now in the past, like when you're looking at 2008, 9, 10, back then, we were pretty strict with this stuff. We wanted it in a
Mm.
bank.
Yeah.
So here's why I say that, Brandon. There was a time where you have access to bank lines, for example. Now
Yeah.
you do have access to that money. You can go out the very same day and go pull out money and solve
Yeah.
the problem.
Yeah.
Right. But what we were seeing is the bank lines were shutting off without notice. So they didn't really have the access that they wanted. Retirement accounts are very similar where they don't, I mean, they may have access, but they may not want to access it because there are penalties and these types of things. So we said, move it into a very liquid, FDIC insured type of an account, a savings account, and then you're qualified. If you don't want to move it, then we're not going to do the deal with you. Since the crash, we have loosened up on those guidelines. And if you could just show us that we have access to it and we're confident that you will access it if you need it, then we'll do the deal.
And here's something I've seen. So somebody was looking for that, and so we needed to qualify. So what do? We took a loan,
Loan. Exactly.
put it in the savings account, qualified, then put it back,
Paid it off.
and then we were good to go, right? So if it was needed for that, but that's why working with people who actually know how the system works is really important, right? Because then we're able to oh, okay, I see where you're going. How do we work that? And not all companies are easy to get loans from, I would bet you. In general, even life insurance, I'm like, yeah, not all of them are created equal, just like banks. So knowing that you have the right ones like that are gonna be able to transfer money pretty fast, relatively speaking, right?
Yeah.
But that's something I've had happen with clients multiple times. They're like, okay, I'm trying to qualify. It's not seen as liquid, easily liquid. So we just made it liquid for a short time.
Yeah. And
Liquid.
as a lender, obviously, we don't want to hear that. But look, we can only qualify up to the day of closing. And then what you do after that, we have no control over. So I want to make sure you're being smart as I possibly can up to closing. And
Yeah.
then I do know that people will take money off of a line, put it in their bank, qualify them, and then pay off the line. I get it. I would just prefer that our borrowers are being very, very careful and safe.
Yeah, and I wouldn't do that with a home equity line of credit or something like that, because that's then different, I think, interest rates. But you want to make sure, really, as a lender, and as you as the giver, I guess you could say, is that we are doing our math on all fronts. Because I don't know, I've seen so many people who are like, if I get 100 properties, then I'll be financially free. And I'm like, and I don't know, you'll have financial headaches because you have 100 toilets times 3 to deal with, and maybe that's not what you want.
You might be doing financially well, but I can tell you'll have tenant headaches.
Yeah, and maybe, and that's again why I believe knowing your numbers, profit first for real estate investors. A lot of people are making a lot of money, but the banks are making more. And so using people like Kevin for the short term to be able to then probably refinance if it makes sense. I'm sure they use you and then you're working on refinance deals.
Absolutely. It's a great way to buy properties with very little money down. So if you're looking at and borrowing from a hard money lender, which is basically what we are, I know the industry doesn't like that term, but I've used it for 18 years. So
Yeah.
if you're borrowing from a hard money lender that's willing to do some high leverage lending, which most will, you could get in for a limited down payment, a smaller down payment. Once that property is cash flowing, like you clean it up and get a tenant, now you can go to your conventional lenders and you would qualify for the refinance, right?
Right.
So it's a great strategy if you're trying to acquire rental properties.
Now this is something I like to think about. So if I go to a real estate investor group, there's all these private money guys,
Oh yeah.
right? And I know we've talked. I know my friend Jay that is really great. But what makes you different than the other guy who's going, I'll give you this, and it's more like a shark, right? How do you differentiate yourself, and why would they say, hey, Pine, they're my guys? Right? How do you show yourself different in that real estate crazy world?
Yeah, I mean, the simple answer is client focused. So a lot of people in this business are not that. So they're definitely in it for the transaction. See, this is a transaction business. We make money when we transact. So that's what you want to do. Now, we don't care as much about a specific transaction as much as we care about the relationship. And I mean, here's why I say this, but it might be obvious. If you're successful with your transaction, your fix and flip, you're going to come back to us, right? We helped you make money. That feels great. You did well. You'll come back. And then if you make money, you'll come back. And then you'll tell your friend, then your brother, and so that's how you build a business.
Yeah.
It's not focusing on a transaction. It's focusing on a relationship. Most hard money lenders don't do that. Like they're not going to go through and hold your hand through the project. They're not going to run you through a net profit calculator and show you exactly how much you should be making if you do everything as you described to us.
Yeah.
So these are some of the things that we do that do make us different. All of our sales team, every single one of them, have or currently do fix and flip houses. So there's a ton of experience in this office that you don't get with someone who's focused on a transaction.
I think you just said you're doing what you say you do what you tell people to do, right? I was just talking to a client today, and they're like, "Well, you're going to make money off of this, right?" I'm like, "Yes, I'm a pass-through entity in that regard, but it's about you, not about what I sell you or what is going to be out of it. It's about the end goal." And my job is to serve you and help educate you, because in the end, guess who gets to deal with the consequences? You do, not me, right?
Right.
And so I was telling them that, and at the same time, I want to look at people as, hey, if they were my mom or my mother-in-law or other people that I care about, I'm not going to screw them. I want to have a heart in this, and that's one of the reasons I liked and why I'm doing this interview with you, Kevin. Is your YouTube is financial education, right, or real estate education, right?
Mhm.
That is a heart of a teacher, right? Um, Teacher versus salesperson is very different, I think.
Well, we look at ourselves, Brandon, as being in the deal with them. So
Mhm.
it's not like we're loaning out our own money. I mean, money we've raised from individuals, but I'm not just brokering this off to a Wells Fargo and forgetting about it. Like, we own the relationship.
Yeah,
We're in the deal with you. We're partners. This deal has to be successful for me to get paid.
yeah,
Now, make no mistake about it, we make money. And I don't think any borrower or any client in any financial career or job would not appreciate that,
yeah, right,
right? We need to make money or we wouldn't be able to loan you money, right? You
right,
need to make money or you're going to be out of business and you're not going to come back and borrow from us again. So
yep,
we both need to do well. Now, the reality in this business is you, the borrower, should make a hell of a lot more money than I do, right? Because I'm in a
yep,
much safer position. So if
yep.
you're doing what you're supposed to and taking advice, you should be making a fortune on your projects. And then you just pay us our little piece that we agreed to, and then we go do another one.
And I think that's knowing who you are as an individual. And For me, I love notes because I have another business that I operate, and I make more from that.
Yeah, exactly.
And so it's a way of knowing your skill set, knowing also playing the game of real estate, and I think that that's important. But a lot of times people are like, yeah, well, Joe Smith, who he's doing storage facilities, I need to do that. And you're like, do you know anything about that?
Good luck.
Car washes, what, I don't know, you name it. I've heard all of them, and so you have to know who you are, and that's the problem. Is most people don't know themselves, and then really dial it in, and then you play. Like I might buy another Airbnb or something. I don't know, but it's just a hobby, and because I have a real business.
Yeah.
Um, what do you think? And I know you don't have a crystal ball. World is crazy, but where do you think? No, the next year in real estate, like it's been a wild ride this past few years. Um, yeah, what do you think? What do you think if you were to pull out your crystal ball that's behind you? Uh,
It's interesting you asked that because we just did our company meetings. We do all of our planning meetings. So our entire team gets together. And one of the things that came up was I had made a comment, Brandon, that I don't think interest rates are going to start with a 5 in the next 2 years at a minimum.
mhm.
And I might be wrong on this, right? Because interest rates do bounce around, but I don't see them going even in the high fives anytime soon. I know a lot of real estate investors are hoping and expecting that. The Fed has come out and said we're cutting rates, we're comfortable with inflation, and it's not directly correlated, but over time there is a correlation between the short-term and long-term rates. So the general expectation is rates will come down. Now, here's why I don't agree. It doesn't matter who was elected. Now, I'm not going to go political because they both had very similar policies. They're
Mhm.
all inflationary. One says we're going to cut income without cutting expense. The other one says we're going to keep income the same and we're going to increase expense. So a little different take, but the exact same result, deficit. When you have deficit, you have to print money to pay the interest on that debt. And for the first time, our interest, this is scary stuff we're talking about.
Yep.
Our interest on our federal debt surpasses our military spending. It
Yes.
has done that now. So it is 120% of GDP, which you haven't seen that since World War II. It's extremely scary situation that we're in. And the way out of it is to print more money, which what happens when you do that? it causes inflation. So
Yeah.
every policy that I'm seeing is inflationary, whether it's tariffs, whether it's immigration, whether it's cutting taxes, they're all inflationary. So I would expect to see that increase. And when inflation increases, so do interest rates. So I think that these types of policies are going to hold rates up until we can get a handle on this. I mean,
Yeah.
I'm going off on a tangent here, but the only thing saving us, honestly, Brandon, is that China prints 9 or 10 times more than we do. Otherwise, we would be in real trouble.
Well, and people don't see that, right? That's the thing on the bubble within our real estate. Right? People were getting a lot of money in COVID, and I remember. I don't know if you were doing interviews and recording.
Oh, for sure.
I was like, oh my gosh, this is going to increase everything. And then no one's listening. They're all like, "Oh, it's easy money. It's free. Let's go buy a bazillion houses," which is fine, right? But you have to know that there's going to be a shoe dropping. Then we'll blame whoever's in president. It doesn't matter. But I'm like, printing money, and it all is correlated. And so that's something that, again, as probably as you're doing your underwriting, you're having to look at those bigger pictures that most people are like, oh, but eggs are expensive now. And I'm like, well, there's a cause for that, not just because Trump doesn't like chickens, right, or something. It's something else, right? There's some other aspect, and I just made that up. I don't know if he likes chickens or not. Just so you guys know, I don't know where his stance is on chickens. Don't hate me, but you know what I'm saying, and that's interesting, right?
Well, here's how we benefit. You're talking about saving world problems here. Let's save our own problems first. Here's how
Right?
you benefit. When you have these types of policies, it hurts the lower and middle class. And the reason for that is because they don't own assets. Okay?
Yep.
They might have their house that they live in and their 401k, and that's sort of it. The wealthy buy assets. So you made a comment that, well, they took all this free money and went and bought houses. Well, that's genius because real assets, especially tangible ones like real estate, will go up in value. And then you saw double-digit appreciation rates for a couple of years after COVID and all the stimulus. So people who owned real estate did very well the last 5 years, right? And now
I would qualify the smart ones. Not everybody did. A lot of people went and spent it on Macy's or something else.
Well, that's what the government wants.
Exactly.
Right. That's stimulating. That helps create jobs, helps do all the things that the government is trying to accomplish. So absolutely, here's free money. Now go out and spend it on clothes or food or whatever. Go out to eat. Take your family on a vacation. That's exactly what the idea is. The ones that don't do that benefit. The ones that do end up paying for it. Because then we have inflation. Inflation hurts lower and middle class more than it hurts upper class because it's a tax. I view it as a tax. And so I know a lot of people don't agree with me on this, but it's a very fair tax because everybody pays it. Right. So that there's no tax brackets. There's no let's increase taxes on the investors that have assets we can tax on. No, everyone pays it because you're paying it at the cash register.
Yeah.
Right? So it's interesting when you see this free money go out that they're trying to help because they're giving it to the lower and middle class. The people they're trying to help, the classes they're trying to help are the ones that end up getting hurt.
Well, and again, I think the stimulus, if you think about economy and you think about the human body as well, I'm like, wait, we put in a stimulus for people with type 2 diabetes, right? We kind of do that kind of insulin to keep going, to keep us going. And I'm like, well, the human body cannot, if we keep eating McDonald's all day long, it will cause problems, right? And so this bloatedness and all of this is a challenge that we want to have that high value. I don't know. It's a challenge, and I don't want to be in politics or any of that. But I'm like, let's look at it and know that I'm in control of me, right? How do I make a good position for me, my family, my son? Think like those rich people do, because they are thinking 4 generations. Real estate is one of the best. Don't just spend it on other things. Or also learning from big business that has done well. McDonald's, as you said, is real estate. They own the land that they're in. They're not in the burger business. They're in the real estate business.
Right.
Anybody that thinks that they're just in that space of not, that's a problem. So, have you been to Ohio? Ohio had a company that was Frisch's Big Boys. Have you heard about that?
No.
So Frisch's was a staple in Ohio. So what I read, and they're now going under. Well, they needed money, and so they had their properties, but they sold the properties to get an infusion, right? And then interest rates went up, and now all of the big boys in Ohio had to sell, because what did they give up? Their greatest asset, real estate. They weren't in the burger business. They're in the real estate business, but they said, "Oh, well, we need this," and so they gave it up to a hedge fund or something. I don't know. But yeah, check it out. Big boys. What happened to them? Frisch's. I was like, "Whoa,
I'll
that's a
take a look.
story of McDonald's versus another similar business." So I know we got to run. Anything you want to leave the listeners with?
Yeah, I guess I'll just say this, Brandon, as we close out. We talked a little bit about the economy, and I know there's a lot of fear what's going on. Administration change. We have inflation that's very sticky. You have job numbers, which we didn't even get into, that makes no sense. We have expected more spending. There's a lot of scary things. So I get questioned a lot. Is this like the 2008 crash? Are we going to see real estate values go down? Should I be buying right now? The answer is no. But we do learn from history. So if you keep going back through recessions, most don't impact real estate, by the way. A lot of recessions actually increase the value of real estate, which is a surprise to most people. But if you go all the way back to 1990s, early 90s, there was a little blip. It was about a 14% decline in property values, which is definitely a real estate recession. And that's the last one that has the most similarities to what we're going through right now. We're talking about high interest rates, high inflation, that type of thing, that right after the savings and loans crisis. So I wrote a report comparing today to that time in history to try to learn what we can so we can be better prepared. If we want to be wealthy, we need to understand how money moves. So I wrote that report totally free. Your listener can get it at thepinereport.com.
Oh, I'm going to check it out. Well, thanks and I'll put that in the show notes here. Thanks, Kevin, for being here and showing your knowledge. So guys, go listen to his show and Real Estate Educators.
The Real Estate Educators, yep.
Yeah. And again, educate yourself. Don't just take my word or Kevin's word. Actually know your own numbers and know your goals and then go into it, right? And there will be ups and downs. There will be black swans. It's everywhere.
That's right.
But we want to be in a place that we can be in control. So with that, thanks for joining us, and we will see you guys next time.
Thanks, Brandon.
There we go.